Welcome to Skytech-Lens. In 2025, Stellantis faced a chilling threat, a 25% US tariff on imported cars and trucks. The automaker's bold response: shift Canadian production to the US, betting big on American soil as a safe haven. The plan was massive, $13 billion over 4 years, promising 5,000 new US jobs and signaling loyalty to the American market. The groundwork began in 2023 with the closure of Brampton, Ontario, idling 3,000 Canadian workers and foreshadowing the shift. On paper, the move seemed logical: avoid tariffs, protect market share, and please a US administration eager for reshoring. But Stellantis underestimated the tangled web of North American supply chains, built over decades across Canada, the US, Angstein, Krontuwan, and Manami, Cornsico. The abrupt relocation ignored deep dependencies and hidden costs, unraveling a finely tuned system. The company gambled not just on logistics, but on the stability of the entire political and economic landscape. The tariff, effective April 3, 2025, threatened to make Canadian and Mexican-assembled vehicles uncompetitive. Stellantis's leadership believed swift action would outpace rivals and win political favor. Yet, this high-stakes bet failed to account for the complexity of cross-border manufacturing. The decision was a roll of the dice, one that would soon prove spectacularly and ruinously wrong. The stage was set for a corporate disaster. The markets wasted no time. Stellantis's stock plummeted as soon as the production shift was announced. Investors saw not a clever tariff dodge but a leap into chaos. Analysts warned that any tariff savings would be wiped out by soaring US labor costs, volatile energy prices, and complex Buy American rules. The share price collapse was a vote of no confidence, not a temporary blip. By mid-2025, the company faced $300 million in unexpected costs from the chaotic transition and new tariffs on cross-border parts. Losses mounted, a net loss between $2.3 and $2.68 billion in just 6 months. Jefferies analysts projected losses could exceed $7 billion by year's end if the bleeding continued. What began as a strategic move had become a full-blown financial crisis. Stellantis's reputation for shrewd management was in tatters. The market's message was clear: this gamble had failed. The promise of a seamless US transition quickly unraveled. Labor costs in states like Illinois were 25–30% higher than in Ontario, and energy prices surged 40% after federal subsidies vanished. Instead of savings, costs soared. Buy American rules forced Stellantis to rebuild its supply chain, severing ties with efficient Canadian and Mexican suppliers. Logistics bottlenecks and component delays crippled US operations. Productivity plummeted. Key plants in Michigan and Indiana ran at half capacity or less. Temporary shutdowns and halted Jeep production in Mexico followed. The dream of a robust American hub became a nightmare of idle factories and broken supply lines. The human cost was immediate. 900 newly hired US workers were laid off or put on standby. The restructuring and underused assets added $3.3 billion to the company's burden. The American dream had become an operational quagmire. There was no easy escape from this mess. The costs, financial and human, kept mounting. The fallout was just beginning. While Stellantis struggled in the US, Canada responded with legal precision. Ottawa and Ontario reminded Stellantis of its binding 2022 agreement, which tied public investment to maintaining Canadian operations, including Brampton. A formal letter warned, break the deal, face severe financial and legal consequences. Canada activated protective clauses, making withdrawal prohibitively expensive. Federal agencies prepared to claw back funds and seek damages. Stellantis was trapped, crushed by US costs, and facing a legal battle in Canada it couldn't win. Canada's strategy showcased the power of contract law over political bluster. Stability and predictability proved mightier than tariffs. Stellantis had no winning cards left. In Windsor-Essex, Canada turned crisis into opportunity. Stellantis added a third shift at Windsor Assembly, preserving jobs and signaling continued Canadian presence. The centerpiece, the $5 billion Nexstar Energy EV battery plant, a joint venture with LG. Ontario accelerated retraining, moving over 2,000 Brampton workers into high-tech roles at Nexstar. This transition kept manufacturing expertise local and fueled the region's EV future. Over $1.2 billion in private investment flowed in, retooling parts suppliers for EV production. the local economy stabilized, unemployment held steady, and Ontario's auto parts exports to Europe soared 18% in Q3 2025. While the US auto sector struggled, Canada emerged stronger and more diversified. The crisis became a catalyst for renewal. Canada's strategic pivot paid off. The region was now a North American EV hub. The Stellantis debacle sent shockwaves through North America's supply chain. Canadian parts suppliers reliant on Brampton faced layoffs and existential threats as orders vanished. US plants, cut off from Canadian and Mexican partners, scrambled for new domestic suppliers, often unprepared for the surge. Production delays, quality issues, and spiraling costs followed. Logistics buckled, trucking routes changed, warehouses overflowed, and assembly lines stalled. The just-in-time model collapsed, replaced by costly stockpiling and panic buying. Policymakers had misunderstood the reality. Auto manufacturing can't be neatly contained by borders. Tariffs hit not just finished vehicles but the countless parts crossing borders multiple times. Ford's CEO warned the tariffs were harming the US industry itself. The once strong supply chain became a critical vulnerability. The ripple effects were felt everywhere. The tariff war's human toll was starkly different in Canada and the US. In Canada, unions and governments coordinated retraining and support, moving over 2,000 Brampton workers into Nexstar's EV plant. Workers found a hopeful path forward, securing long-term prospects in their communities. In the US, the promise of 5,000 new jobs evaporated as chaos set in. Layoffs hit 900 new hires, and job insecurity replaced optimism. The UAW, which had championed the tariffs, was powerless to protect its members. Canadian workers were retrained for the future. Many Americans were left in limbo. The policy meant to protect US jobs had backfired. Building walls trapped workers on the wrong side. The lesson: global industries need global solutions. The UAW's alliance with the Trump administration on tariffs was a high-stakes gamble. Union President Shawn Fain championed the 25% tariffs, hoping to reclaim US jobs. The rhetoric was strong, but warnings from industry experts were ignored. The policy caused disruption, higher prices, and ultimately more layoffs than jobs created. As Stellantis floundered, the UAW's victory turned hollow. The union faced a credibility crisis, caught between protectionist promises and factory floor reality. The alliance, once bold, now looked like a grave miscalculation. The UAW's nostalgia for a walled-off industry clashed with the reality of integrated supply chains. The fallout was a painful lesson in the risks of simple solutions to complex problems. In the global economy, risky alliances can have costly consequences. The Stellantis saga is a cautionary tale for global corporations. The company's attempt to sidestep tariffs by shifting operations triggered chaos, not savings. The US approach, volatile and protectionist, created uncertainty and risk, while Canada's rules-based response protected its interests and reputation. The crisis proved North America's auto sector is a single, integrated entity. Tariff walls only cause collateral damage. Consumers paid the price, with vehicle costs soaring and industry stocks tumbling. The lesson: stability, predictability, and the rule of law are invaluable. Hasty reactions to political whims can lead to financial ruin. Stellantis's failure and Canada's resilience will guide future global strategies. Thanks for watching. Subscribe the channel for more updates.